Hello, team. I hope that all is well. I just decided to come up with just a short video whereby I'm just going to talk about convehancing briefly. Just the theory around that. Sometimes we take this for granted. I just thought maybe because I realized that most of the students, what they are aiming to do is just to go to the question and try to solve the question. Remember, everything is all about the basics. Everything is all about the foundation. If you don't understand the foundation, you will never be able to apply. Okay. It's like in a Forex environment, when you are dealing with Forex, you can't just go and involve yourself in Forex. You need to go to the basics so that you can be able to read the market and things like that. Okay. So I just wanted to go through this just to check if maybe I can be able to lay the foundation so that when you go to the recording of these transactions, everything can make sense. As you can see here, I've got sale of property. Remember, when you sell property, there are some parties which are involved in the process of selling that property. As you know, in most cases, we have got the seller. Obviously, you must have the buyer. So at the end of the day, the seller will be selling this property to the buyer. But sometimes, in most cases, we don't just sell directly to the buyer. We do have the middleman who is going to assist in the process of selling that property. Now, as you can see here, I've got the seller as the owner. And the owner obviously is the owner of this property, which is going to be sold in the market. Okay. But the seller will have to make sure that he has got someone by the name of what? Estate agents. I think those who have bought houses before, this is the process, the simple process. So before we can go to the accounting part of it, we have to understand the process. So obviously, the seller must have an agreement with the estate agent so that the estate agent can find the buyer so that at the end of the day, the property can be sold to the buyer. So they need to agree on the commission, So obviously, normally they say 3% of the purchase price, and it depends on the agreement between the seller and the estate agent. That's why sometimes when the estate agents, let's say for example, you are interested in buying a house or a property, they normally ask you how much do you expect from this property. It's because again they've got something in mind because they need to check at the end of the day, how much will they get from that particular property? Because their 3% will increase, the amount in rents will increase based on the value of that particular property. So the seller need to appoint the estate agent and agree on the commission. And thereafter, it is the responsibility of the estate agent in order for him or her to find the buyer. Can you see now? The buyer is found by the estate agent at the end of the day. And then again, remember, as I said, this is the process at the end of the day. We've got the seller, we've got the estate agent, and again, the buyer need to be found, and thereafter there's something called offer to purchase that you need to sign. I think those who have bought the houses, you know the process. I think you know better as attorneys at the end of the day, you know that you need to have the offer to purchase, which must be signed by the buyer. And thereafter, after signing all those things, remember the property at the end of the day needs to be transferred to the buyer at the end of the process. And the transfer again goes hand in hand with the registration of the property. Is then that at the end of the day, we have got what we call the conveyancer, who is going to transfer the property from the seller to the buyer or to the purchaser. Can you see now? This is where we are going to be involved as the bookkeepers or as the bookkeepers representing the firm. So we are going to be involved in this process. So our accounting process will be in this process. Remember, as the conveyancer, at the end of the day, you will have to have some process, the documentation and things like that. Remember, at the end of the day, you have to go and register this property with the deeds office. So during the process, you must make sure that at the end of the day, the accounting part of it is up to date, because it's not all about preparing those documents. Again, it's all about availing the records for the buyer, so that the buyer at the end of the day can easily see the process that has been followed for the transfer of that particular property. So we need to make sure that we understand that we as the conveyancers, the accounting part will start here. Can you see now? Again, the process, remember the seller can have his own accounting books. The estate agents, they are also running the business. They've got their own accounting books. And again, the buyer can have got his or her own accounting books. But here, remember, it's all about us as the attorneys. We have to go and transfer from the seller to the purchaser. I'm referring to the property. But you must know that the transfer can only be effected, or can only take place only after the property has been registered. So you can only transfer the property only after the registration of the property has taken place. Now, that's why when we go through, you'll see at a later stage, when we go through the books of accounts, you can see there are processes. We first receive money from the purchaser, and thereafter you will see that we are going to register that property. When we register that property, is then that we transfer the selling price or the purchase price to the seller. That is the process that we need to follow. And thereafter, remember, there is a process. Our main thing here is the bookkeeping of the whole process. So when we go to the bookkeeping, so that's why I said here the conveyancers bookkeeping process. Remember, there are some documentations, there are procedures and the processes to be followed. But at the end of the day, our bookkeeping process must be up to expectations. So firstly, remember, the normal account will come. I expect you to know at the moment what is an asset, what is a liability, what is an owner's equity, what is income, what is an expense. And again, you must know that we need to separate the business books from the trust books. So this is something that we have learned before. So we must know the difference between the two. By now, those who have been following me, for those who have been exposed already to this bookkeeping, you know that you must always separate the trust books from the business books. So the normal process of trusts and the transfers will still take place here. Remember, we normally have the trust. Remember, the trust money is the one that we keep on behalf of what? Of our clients. And the business books is normally our own books, where we transfer what is we are entitled to. We transfer from the trust to the business. Now, you know that the main account here, we normally have the trust bank account. Sometimes they call it a trust cash book. So a trust cash book must be opened, and on the other side, you must have the business bank account. Remember, they are both bank accounts. The rules of account equation will still come here. The rules of accounts will still come here, irrespective of where you see this bank, whether it's trust bank or business bank. The rules of accounting will remain the same. A bank is an asset increase on the debit side, an asset decrease on the credit side. Obviously, when we receive in the trust bank account, that's how we go to the debit side. But when we pay money out of the trust bank account, we normally go to the credit side. The same applies to the business bank account. When we receive money, we increase on the debit side, and when we pay out of that business bank account, we go to the credit side. And remember, the amount of money that we receive from our clients, we still owe the client, because we still have to satisfy the client when it comes to the services. So that's why when the buyer gives us money, because sometimes they give us money in advance, they deposit money in advance. So we need to have a specific book for each buyer. That's why we say purchaser trust account. So if it is Sylvester here, it's going to be Sylvester trust account. So the word trust will make the difference. Well, the minute I see trust account, purchaser trust account, automatically I know that this is my liability account. Why? Because the money that I'm going to keep in this book belongs to my client, because I still have to perform on behalf of my client. That's why you'll see that when we record in this purchaser trust account, we are going to record on the credit side as long as we receive money in that trust account. So we're going to record in the credit side of the trust account, but under the trust bank account, we record on the debit side. That is what the double entry system. When you debit trust, you create trust account, you will debit bank account, trust bank account, and vice versa. But at the same time, remember, this purchaser at the same time is also our client. That's why on the other side here, we must have purchaser business account. Can you see now? So this means he is going to be my client. So it means when I start charging the fee, it means I'm going to use this one with the business, but when I receive money from the client in advance, I'm going to record under the trust account. Can you see now? So we need to know the difference between the two. So in a nutshell, this one will be a creditor. Sometimes we call this a trust creditor. Okay, and this one is going to be a debtor. Can you see now? So a purchaser, a debtor, or a client. So here a debtor is an asset increase on the debit side, but the purchaser trust is a liability, and this will increase on the credit side. Now let's move on. Again, remember, seller at the end of the day here is going to be involved. Even though the seller will be involved at the end of the process, by the time when we are ready, we have registered the property. Remember, if you register the property, at the end of the day, the property must be transferred to the purchaser. By the same time, the seller is entitled to the selling price that is going to be paid by what? By the purchaser. Again, we need to have a seller's trust account, because remember, we owe the seller at the moment. Again, like I said, when you see the word trust, it means at the end of the day we owe. It's a creditor. So again, as you can see here, I've got seller so that I can use this seller's trust account by the time when I transfer the amount from the purchaser to the seller, and at the same time that amount must also be transferred from the trust bank account. Okay. And again, remember, we are in business here. We are not running any charity organization. So at the end of the day, after we have performed our services, we are entitled to the services fee that we have charged. Maybe we have charged 100,000, maybe we have charged 5,000. So there must be a fee account that need to open. And again, a fee is always going to be the income to the business. That's why this account is under business books. Can you see now? But we can only charge, we can only record in the fee account after we've performed. After performing, remember, we are owed that fee. That's why we must come and increase this fee on the credit side. Remember, a fee is an income. So incomes increase on the credit side. Those who have been exposed to this process, we know that there's something called a pro forma statement. That statement will show the fees which we have charged. That fee statement will show the amount of transfer duty which we have charged. So at the end of the day, we need to have that statement which can show us the fees which we have charged. But remember, in most cases, your businesses are what? You are VAT vendors. You are registered for VAT. The fact that you got the fee, SARS will be interested in your books, because the minute you charge a fee, SARS will also need their share. That's why you need to make sure that you check whether you qualify for registering for VAT or not. Because if you are registered for VAT and you don't charge VAT on the fee that you received, SARS is at a better position to come and claim that VAT from you, even though you did not collect that VAT from the purchaser. Can you see now? You need to be careful. If you are registered for VAT, you need to make sure that you charge VAT, and that VAT that you charge is called output VAT. Output VAT is the VAT that you charge when your customers you are billing your customers. Can you see now? So that is called output VAT, and output VAT belongs to what? Belongs to SARS. But remember, we also have input VAT, the one that we pay when we go and buy stuff as a business. That one will be claimable from SARS. So again, output VAT will always be classified as our liability, because this amount does not belong to us, it belongs to SARS. So the liability will always increase on the credit side. That's why you will see here, again, we're going to record on the credit side as long as we charge this particular output VAT. Can you see now? So that's what I'm saying. The normal process of accounting is still going to be followed, even though we're under a different process. Can you see now? So you must make sure that you know those rules. Those rules will always apply. And remember that we still have to do what we call the transfer journals. Remember, whereby you transfer. Remember, the fee that you charged here obviously will be charged on this account called purchaser business. Remember, I said to you, purchaser business is the same as the client account. So the fee that you see here will also be reflected here. The minute you see the fee in this account, it means you have to go and check if the trust account has got enough cash to pay that fee. So if that trust account has got enough amount, we are going to transfer. Remember, I told you about the transfer. I told you about the transfer. So the transfer always take place between the business and the trust. Can you see now? So that's why you must make sure that you always do the transfer. The transfer always take place between the two. That is where the transfer take place. You must make sure that you always understand that the transfer takes place between the business and the trust. Can you see now? But if, let's say, the transfer is between the trust and the trust, can you see now? The journal that you're going to use, you're not going to use the transfer journal. You're going to use a journal called trust journal. There's a journal called trust journal. It's when you transfer from trust to trust. But when you transfer from the business to trust, that will be called what? Will be recorded under what? A transfer journal. I hope everything makes sense, guys. I just wanted to make sure that I give you this important information, and hopefully everything makes sense. Good luck for everything, and I hope that all is well. Thank you so much, guys, and then I'll see you soon. Make sure that you study those books and make sure that